Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited. Today we're going to talk about should you invest in a promissory note fund as a passive investor? Now, if this is your first time joining our weekly webinar, we address topics in this weekly webinar. If you want to learn how to turn your active income into passive income and long-term wealth. Now, if that's you, you're in the right place because maybe you've tried to invest passively before, but couldn't get quite comfortable making the investment, or you actually invested in a deal before and you're like, oh, I made a mistake, or you just simply want to sharpen your skills. If that's you, you're in the right place. Now, if this is the first time we're meeting, again, my name is Whitney Elkins-Hutten, and I've been investing in real estate since about 2002. I started off very actively as a live-in flipper and house hacker, scaled through single-family rentals, then eventually got into multifamily investing on my own and then through partnership, and then into larger syndicated deals, and now have actively partnered in over 800 million in real estate, flipped over 500, or excuse me, 5 million, wish it were 500 million. But I just shared that wealth of information with the audience here as the Director of Investor Education and passiveinvesting.com. And also in my book, Money for Tomorrow, How to Build and Protect Generational Wealth, published with Bigger Pockets. Now, all of that is to help you understand, how to do one thing, which if you're a passive investor, this is probably what you're aiming towards, is that how do you get 100% choice and control on how you spend your time? You see, a lot of people, when I talk to them, they say, hey, I want to be financially free or financially independent. Great, that's the tool to get what you really want, those other freedoms in life, which are choice, time, maybe location independence. Heck, maybe even you want to be able to create a legacy, create an impact in the world. And we can help you do that here at passiveinvesting.com, whether it's through our equity investments like multifamily, self-storage, or express car washes, or through our debt investments like the real estate debt fund. And more importantly, our PIK yield fund. I mean, that's what we're going to talk about as an example later on today. Okay, but this is your invitation before we dive into today's topic to join the Passive Investing Club. There, when you join our list there, you get priority access to our open deals, a one-on-one call to discuss your investing goals, and then weekly educational masterclasses and additional resources. Now, you can join the Passive Investing Club by scanning the QR code on your screen or going to the website passiveinvestingwithwhitney.com. Now, as always, the webinars that we do here are for educational purposes only. So it's not financial advice, legal advice, tax advice. So make sure you take this information and consult your investing team before making any investment decisions. Now, today's topic, we're talking about should you, as a passive investor, actually invest in a promissory note? So let's kick it off. Like, what is a promissory note? Okay, and if you're watching the video, we've got our illustration in the capital stack here. We're going to talk about where it fits in here. But essentially, a promissory note is a legally binding agreement where the borrower, okay, in this case, the promissory note fund, commits to repaying a lender, which would be you as the limited partner investor, to a specific amount of money, including interest, over a defined period. Now, that's about where the various promissory notes, like the similarities between the two, actually end, because the promissory note can have all different types of security, duration, so many variables in there can change. But all promissory notes are generally in a secondary or a secured position in the capital stack. So they're going to sit behind the senior debt, which often, say, like on a multifamily deal, is going to be the bank debt. Okay. They're going to be prioritized repayment, meaning it has to be paid. It's an expense to the business, okay, or expense to the asset, depending on how it's secured, before any equity distributions can be paid. Okay, promissory notes generally have very clear terms to them. Okay, they're a pretty simple, straightforward instrument. And they have predictable cash flow. Now, that cash flow might be current pay cash flow, meaning you get it every month or every quarter. It can be deferred cash flow at the end of the note period, or it could be some blend of the two. Now, why would a general partner actually use a promissory note? Okay, well, actually, before we do that, what are the different types of promissory notes out there? You can have all sorts of promissory notes. Okay, if you think about it, promissory notes, you can find them in the mortgage arena, you can find them in the student loan arena, you can find them in corporate credit, you can find them in business loans. Okay, so just promissory notes in general, we see them all the time. They're just not called that. Okay, they can be structured formally. They can also be very informal. They can be secured, they can be unsecured. Okay, so as a limited partner investor, we want to learn how to watch out or evaluate promissory notes, and we'll get into that framework here in a minute. Now, the payment terms can also be just as elusive as like the kind of promissory note that you might be investing in. It can be an installment note, meaning where you just get chunks of money back at, say, quarterly intervals, annual intervals, or maybe even just at the end. It can be a lump sum note where you get everything at the end. It can be an open-ended note, meaning there's no time duration or payment term on it. Or it could be a demand note, meaning there's some sort of triggering event to where the limited partner can then go demand their money back plus their interest at a certain period of time. Now, promissory note investing, again, remember it's in that second tier, okay, right behind the senior debt. It's going to be simpler structure and more straightforward and lower risk than our private credit investments. And one of the reasons that make it lower risk is you can generally see the underlying asset that is being pledged or secured. Now, why would a general partner actually use a promissory note versus going to the bank to get, say, a second lien on their property or going to an outside institution to get private credit? Well, let's talk about this. Okay, so general partners, can utilize promissory notes because if they went to a bank, all right, to get a second lien on, say, their, a piece of property, that would burden the title, okay, and it would also delay execution, all right? Now you start also bringing in what we call inter-creditor conflict, and that would happen with either bringing in a secondary bank credit, okay, meaning now you got the senior debt position and a secondary debt position, trying to figure out terms with each other, or even a senior debt position with a private credit lender coming in there. Okay. Promissory notes can actually, when the general partner controls the promissory note and how it comes in the terms, it can actually help out the common equity class, that's currently in the deal, simultaneously while giving the note holders a priority in the return. Okay. So it can create a win-win situation as opposed to creating a potential win-lose situation amongst the different layers of the capital stack. And also, it's another way to keep the returns in the investing ecosystem as opposed to paying a higher return to, say, like a bank or to a private credit lender. All right, so there's, again, some advantages to using promissory notes, either individually or within a fund, but how do we start learning how to underwrite them? Well, just in general, there's just some things that we need to know about promissory notes before we invest in them. One, we should always invest directly through the operator that we know, like, and trust. Okay, we want to have complete clarity there. And we're going to talk about this specific house in a minute, but we want to be able to see the asset and we want to be able to see the financials around that asset. Okay. Before you ever invest in a promissory note, we want to make sure that it's legitimate and that the actual business, okay, or the asset can actually pay the debts. Okay, meaning they needs to be performing. Okay, a promissory note on an underperforming asset just adds an immense amount of risk. All right. We also want to, make sure that the promissory note's structured as such that it's, protected by the SEC under Regulation D. In this case, we're talking about a 506C investment. Okay, we want to make sure they're properly registered. Okay. or exempt from registration, okay, following specific rules of the SEC. Now, here's kind of like my pro tip. There are two big ifs here. If you're being sold a promissory note, and that you want to make sure that the person who's selling you a note is legally allowed to do so. They're their actual operator or they're a broker dealer. Okay, we don't want to go through friends of friends of friends in order to find this type of deal. Okay, we want to make sure also that if it's guaranteed by a foreign insurance company, that it is registered with your state Department of Insurance to make sure the company can actually do business in the United States. Okay, we've seen potential scams. I'm not going to call them actual scams, but potential scams where people go outside into foreign investment, and then it turns out that that foreign investment couldn't even do business in the United States or in that state in general. Now, we talked about kind of like what a promissory note is, how does it fit into the capital stack, what are some general, areas to look at whenever you're considering a promissory note or a promissory note fund to invest. But why should you as an investor actually care about adding an investment like this to your portfolio? Well, if you've been following my webinars for the past several months, we've talked about taking a layered approach to your investing. And maybe you are new to investing, you're building these layers from the ground up. You're adding in your liquidity layer, your cash flow layer, and now starting to transition up to the equity layer. Okay, or maybe you're an equity investor and you're like, I need to add in some of the cash flow layers into my portfolio. Promissory notes can give uh, more cash flow or stabilized return in a shorter time period than an equity investment. So you can get generally 10 to 14% preferred return on a promissory note. It's contracted to be paid out before the equity. You get reduced exposure to the market and market timing. And it can be a great way to kind of counterbalance your portfolio should you be really heavy in equity investments. Now, here's the thing. I would never, and this is a lesson that I have learned over the past several years of investing, don't expect one type of investment to do everything, right? Because this is usually where I have a staunch private equity investor that says, hey, I want to get cash flow, equity growth, tax benefits, use of leverage, everything in one investment. Okay. We want to make sure we have these different layers taken care of. All right. So a good promissory note in the end can offer certainty, clarity, capital preservation, and even cash flow to the lower layers of your portfolio. All right, so we talked about when we need to invest in promissory notes, right? We want to make sure we go into something that's in a secured position, has prioritized repayment, clear terms, predictable cash flow. Okay. We want to make sure it's an actual promissory note, not an unsecured note, not an unsecured debt instrument. That's very clear. We want to make sure we do our due diligence there. But then past that, like, how do we start digging in about the actual assets in the fund? Well, first, we want to make sure that just like we would vet any other deal we go into, we want to make sure we vet the operator. What is their experience? Is the promissory note fund aligned with helping the common equity class navigate the asset across the finish line, but also navigate, aligned with the promissory note investors? We want to make sure there's business alignment between the two. We want to make sure this operator is very clear and transparent in their communication. All right. The last thing you want to do is get into a promissory note fund and then all of a sudden the money goes poof or the operator goes dark and you're not getting any sort of communication or financials, right? We want to make sure there's clear communication. Excuse me. All right. We also want to make sure that the operator has the ability to exit the fund. Excuse me, guys. So we want to make sure that there's the operator has a history of you know, um, exits in their portfolio, but also has clear exit strategy for this promissory note fund. So maybe there's a plan A and a plan B, and maybe a backup plan C. We want to see all those things from the beginning. And then when we're evaluating a promissory note fund to safely invest in it, we want to make sure that we're actually underwriting the asset or the assets that are going to be in that promissory note fund. So take a look at the local market conditions. I mean, that's if we invest in an asset that's in a market where the market is, you know, not heading in a good direction, we can't change that as an investor. So we want to make sure we have some great tailwinds behind that asset. We want to make sure that it is a currently performing asset and then it's in good condition, right? Maybe part of the promissory note funds will be used to complete capital, a capital plan on the asset, but we want to make sure it's in, good repair currently as is, and that we're just doing upgrades to the asset. We want to actually have a clear understanding of how the funds will be used. What is the business plan? Okay. Are the funds going to be used to complete construction or rehab on the project? Are they going to be used to, say, secure a new line of credit or a new senior debt on the project, or maybe like pay for an interest rate cap? Okay. What we don't want to see is promissory funds being injected into a deal that is underperforming and very distressed. Okay, so we want to make sure that things are moving in the right direction for us, right? That this is essentially the water that's going to help the investment grow. So how are you going to get at this? We want to make sure that we're getting, seeing the underlying assets, okay? Making sure that we're getting visibility on the occupancy, the vacancy, the expenses, maybe even the debt service coverage ratio on those projects. Now, that might be in the form of an actual formal pro forma or in video that the operator is putting out to you. And then lastly, part of the business plan, we want to see that clear exit plan, okay, for this particular promissory note fund. And then the third thing that we want to do in order to safely invest in a promissory note deal is to evaluate the structure and the risk. We would do this with any investment we go into. So just double confirm, where are you sitting in the capital stack? Okay, are you in a secondary position, either secured by the asset itself or secured by the business that holds the asset? Okay. Also, take a look, are the assets being cross-collateralized together? Or does each asset itself have its own lending terms, which is my preferred way, because that way you don't get the contagion effect. Okay. How are returns going to be paid? Okay. Are they going to be paid during, via the operations of the asset? Are they going to be paid out of reserves, which we don't want to see? Are they going to be paid out of over raising for the promissory note fund and then paying back investors? We want to see them being paid out of the operations. Okay. And then lastly, just like you would underwrite any investment, where does that actual asset, the investment that's in the promissory note fund, does it actually have reserves? Okay. And if so, how much per asset? Okay. We don't want to see a contagion effect where things are cross-collateralized and poorly underfunded with reserves. So, I just wanted to use our PIC promissory note fund as kind of an example of how we structure, how our fund would stand up to the structure I just showed you, but also what I've seen in the marketplace. So asset types, for us, we love the performing multifamily space. That's what we're using our promissory note fund for, rather than using it for distressed assets with uncertain performance. All right, the capital stack, we want to make sure it's behind the senior debt, ahead of the equity, okay, and secured by the business itself. Okay, we don't want to be in an unsecured, loosey-goosey type structure. Okay, cross-collateralization, we want to make sure each asset itself is in the promissory note fund is standalone. What we don't want to see, like I've seen in other promissory note funds where there's cross-collateralization in the asset, and then if one goes down, you've got this huge contagion risk across the rest of the portfolio. Use of funds, we want to make sure that we're pouring the watering can on a plant that's going to grow. The soil is there. Okay, all the nutrients are there for it to continue to grow. So we want to make sure that we're using it for reserves, maybe debt restructuring, complete like a little bit of like rehab on the property. We don't want to invest, put funds into a promissory note fund where there's very vague business plan or no asset level pro forma. Like we can't see how they're being used. All right. And then the next criteria here is there a current pay option? This is up to you as an investor, right? Do you need a current pay option with a promissory note fund, or can you take advantage of a deferred option, or do you have options for having a current pay and a deferred pay? Okay, and again, we also want to look at the exit strategy. We want to see clear exit strategies modeled for like sale, refinance, or a recapitalization event. We don't want the business plan to hinge solely on a refinance, okay, especially in today's volatile market. Okay, and then tax benefits. Now, here's the thing, in a promissory note fund, you are on the debt side of the investment. Okay, so there are no tax benefits by design for that very reason. Now, I've actually seen promissory note funds out there that falsely promise that some way, somehow, there'll be a capital inject, an equity profit share, and there might be a little bit of tax benefits. I find that to be a little bit more of a marketing ploy, if anything. So again, this just gives you an understanding, maybe, take a screenshot of it and use it for your underwriting of promissory note investments. All right, so I included this slide because to catch people up, we've been talking about, for the past couple months, how do we create this all-weather passive portfolio? And promissory notes slide into this creation of the all-weather passive portfolio very neatly in the second floor of investing, meaning we've got our reserves and liquidity taken care of. We have our low-risk liquid income plays already in place. And now we want a secured cash position that's semi-liquid, short terms, 24, 36 month, with very low minimum volatility. Okay, that's where the promissory note fund is going to play very well. Now, for those of you interested, if you're actually looking for a promissory note fund like our PIK yield fund, our PIK yield fund is actually investing in successful projects to give them working capital with an exit in 36 months or less. And you can see here on the screen, we've got 3 classes, a 10% preferred return class at $50,000 investment with a current pay option of 5% and a deferred pay option. Then we have our Class B at 12% preferred return, all paid at the maturity of the fund. And then our Class C, which is 14% paid at the maturity of the fund. Now, which is right for you? Between different debt investments, what is right? Again, this goes back to our all-weather portfolio. If you're needing just cash flow, take a look at our PIK real estate debt fund, okay? And that cash flow can be current now, you can also allow it to compound for a little bit more of growth later. Now, if you're needing also cash flow, the other option for you would be our PIK promissory note fund or our PIK yield fund. That would give you the 10% tier would also give you a current pay option. Now, if you're looking for low risk cash growth, okay, maybe not immediate cash flow, but cash growth with lower risk, consider the PIK real estate debt fund, allow it to compound. Consider the upper tiers of the PIK yield fund that have the delayed paid options. Now, if you're looking for tax advantage growth with a lot of upside, that's where we're going to start getting into the equity deals. Okay. Now, here's the thing. As an investor, I encourage you to build out all 3 of those layers to build that balanced portfolio. Now, guys, we're going to open this up to our Ask Me Anything part of the show. But before we do so, make sure you join us at passiveinvestingwithwhitney.com. There, you get a free one-on-one call to discuss your investing goals You get access to all of our educational materials, and then also access to our open deals. And with that, guys, we're going to start the Ask Me Anything part of the show. The question came in, how does this relate to building? Okay. If you'll clarify your question, I'm not quite sure what the question is in there. How does this relate to build rent where it starts with land and is less in value than the end product? Um, so the So for our PIC yield fund, we're actually investing in assets that are already built, already leased up, already performing. And so they're in great markets with tons of tailwinds behind them. Okay, so they're not in declining markets. So really all of that, the assets built, the land's developed. So we've taken all that risk off the table. What it is that it actually is injecting capital, working capital into the asset just to kind of get it to its next phase of, position ideally for a sell or a refinance or for some sort of recapitalization event. Okay. Now, maybe there is an operator out there that is taking on a promissory note to develop land. Okay. So use the framework, right? Is that an operator that you want to invest with? Okay. What is the asset? Do you believe in the asset? Like, is it de-risked? Yeah, that's a lot of risk to do develop land. Okay. Because you have to probably take on a lot of entitlement risk. You're going to have to, get all the entitlements. You're going to have to like build the property. You're going to have to lease it up. So there's a lot there. So I would want a clear idea of when the note's going to be exited out. Promissory notes into like land development. I mean, they might say, hey, the note's for, 18 months, but what happens if we have another, issue in the supply chain and construction timelines double again, like they did during COVID? So that 18-month note quickly becomes 36 months. What happens then? Do you get your capital back? Do you get extended? Can the operator actually afford to continue to pay the note even? So it's just as much. This is where I'm not going to actually say the deal out loud, but I have seen deals where it was a promissory note, say like at 18, 19, 20%. And there was some clear high risk there, but the investor, the limited partner investor, was very much set that, hey, it's a promissory note. I'm in second position behind the senior debt. I'm quote unquote secured, but the asset was really volatile. I've seen one in ground up development that went belly up bad. I saw another one where all the assets were cross collateralized that went belly up bad. So don't just look at the return. Okay, we want to make sure the operator and the asset are solid. For LP, should they set up just one LLC to hold all LP assets? Okay, so not a lawyer here. And so I would actually, and this is going to be the next boot camp that comes out for you guys, is how to build your investing team. And so we're going to tackle, legal team being one of those. I would secure a lawyer that is seasoned in security law in real estate. Okay, so if you have a family lawyer that maybe help you write your trust or will or something like that, probably not going to beat them. Okay, we want to make sure that we have somebody that is very versed in securities law, especially if you're going to be a limited partner, and in real estate. Okay, now that they're going to help you kind of figure out what are your risks by investing in limited partnership positions. Now here's the thing, I'm just going to say, maybe I'm a stay-at-home mom and I run the investing side of the business. I'm going to have a different risk profile than if I am a medical physician who's performing surgeries on people. Okay, so I'm going to have those are two different risk profiles. So this is why you have to get a legal team to help you figure this out. Now, a lot of investors will, once they hit scale, maybe Maybe it's 5 limited partner investments, maybe it's 10, maybe it's even 20, right? It depends on that person's risk profile. They will open up an LLC and start retitling all those assets or investing in new assets within that LLC. So essentially, there's already the syndication itself should already be in an LLC. So you got kind of like that bottom up protection, right? Heaven forbid somebody trip and fall on the property. Like as long as it's run by a business, like the limited partner, their liability is limited as well. So that's going to protect you from the person that slips, trips, and falls on the property or some sort of other like event. By having all your limited partnerships in an LLC, again, not a lawyer here, what you're trying to do is create some top-down protection. And how are those? You're generally going to trigger some sort of top-down protection need in the case of a car wreck that's at your fault or divorce. Those are the two statistics where you're going to generally, unless you have some other sort of business risk, like you're a surgeon or you're in the media field and you're, libel and slander are, huge in your business. Or you're at risk for committing one of those two things, which I think is avoidable. But long story short, that's going to help stop things from the top down. Okay. But I think there's other things you can do before then, and partner with your legal team to help understand what are those other things that are lower cost that you can do before then. Maybe it's setting up a trust, which actually doesn't give you top-down legal protection, other than the fact it's harder for another lawyer to unwind. Maybe you get a personal umbrella policy, in place before you start creating LLCs, because you have to maintain the LLC, right? There's costs to doing that. It's not hard to do, but you do have to run it like a business. But there's no other tax benefit, for a limited partner to put all of their limited partner positions in an LLC, which is another reason why some investors say they did the LLC so they can get additional tax benefits, which, best to my knowledge, again, not an accountant, is simply not true. So, anyway, so I just, the follow-up part of this question is, would putting your limited partnerships in an LLC protect the asset? No, the asset's already, it would protect your investments from being potentially clawed back from you in the case of, say, like you got in a car wreck and it was your fault. It's going to be really hard for the lawyer who's suing you, okay, that party that's suing you, to start unwinding the trust and then figuring out what the LLC is, and then how can they start taking all these positions. That could be one benefit, but again, there's other things we can do before then. So make sure that you're partner with, somebody who's knowledgeable in that space. All right, guys, what other questions do we have coming in here? Probably have a couple more minutes here to field a couple more questions. Otherwise, as always, was this useful for you? I want to know, does this give you better clarity on how to evaluate a promissory note fund? Where it might fit into your portfolio, and how do you balance it out with all your other investment decisions? If so, let me know. I would love to know. And if there's any other topic you would like to see covered, I would love to know that too. All right, guys. If there is not any other questions, we will check all of you guys out next week. We are going to have Gary Pinkerton on for Paradigm Life. He is going to help us understand the math of how to use infinite banking to create velocity in your portfolio. You don't want to miss that. All right, everybody, take care.